Austin, I'm going to pull up a chart here. This is a 2-year chart of TLT and the Qs. I've been getting a lot of calls from my advisor network about the frustration they're having in client communications with regards to the drawdown in the bond market. What's the right way to look at this chart and position communication with investors?
Yeah, I think it's a really interesting chart, and it has a lot to say about duration and the disconnect between the equities market and the fixed income market right now. So if you look back 2 years, essentially this is around the time that the Fed started increasing interest rates at a pretty aggressive pace. And for the first, I guess, about year through 2022, you saw higher duration equities in the QQQ and higher duration fixed income and TLT move in the same direction. They both moved down pretty aggressively through 2022. And then as we enter 2023, you see this unique moment where TLT continues further down, going down another 10% through the year so far. And then you see the Qs recover almost 100% of their value that they lost in 2023. And it's a unique dynamic. I think a lot of it comes back to many advisors are focused on that 60-40 portfolio, and it's been a huge kind of tailwind for many portfolios for the last 30, 40 years. And a lot of that had to do with the fact we were in a pretty long bull market for fixed income. So at any point in time where there was a slight hiccup in the economy, officials tended to try to drive interest rates down through monetary policy to support the economy going forward. That often offset the decline in equity prices in that moment. We're not in the same situation today, as we don't have the luxury of pushing rates below zero. So the Fed had to reset rates to a higher level, and that's where we've seen this disconnect between equities and fixed income. I'm not saying that the relationship is dead forever, but it does seem to be at least not the most reliable in the current moment, as we've seen interest rates rise and we've seen equities act in a different way. So I think going forward, investors need to be more selective in how they think about hedging out their equity exposure, and it can't just be kind of broad-based fixed income expected to bail them out in any time of need.
Adam, I completely cherry picked that chart. So if you're an advisor today or an investor looking at using fixed income to hedge your equity exposure, what concerns should you have, to follow on with what Austin was saying? And is it still a viable solution for a portfolio?
Look, I think there's still a place for fixed income in a portfolio. Absolutely. You just have to be much more cognizant of duration. You can't just go buy anything. If you buying some mutual fund where you don't understand the duration, or they're going to be trading around positions, could create a lot of problems. But if you just go and buy short-dated U.S. treasuries and ladder them and just keep rolling them over, you could capture a nice 5% yield and still have that low duration optionality as things play out and see what happens. And if then you're concerned, but what if rates come down? I won't have locked in a high long-term yield. Yeah. But if rates come back down, the equity portion of your portfolio might be doing so well that you won't care.